Hello guys, I hope everybody is doing good. We're going to be starting out of this chapter called as corporate bond. Okay. Now from the exam perspective, this chapter is theory. Okay. It gives you the basic understanding of what are bonds. Okay. What are the different types of bond? What are the major risks that you face when you actually take a bond? I'll try to take you from the scratch in this chapter. Okay. Mark the section important as we move ahead. From the exam perspective, ideally one question is what you can expect, but this is a building chapter for the difficult concepts which are going to be coming up in book 4, which is related to bond valuation. So that's why we are doing it now, so that later on when we start bond valuation, you have the basic idea. So let us start with the basic discussion. What exactly is a bond? Okay. So suppose if you look at any company, okay, if they want to raise money in the market, why do they need money? Because they want to start out new factories, new product, new service. They want to expand, okay, and they want money. So one way they can raise money from the market is through equity, okay, like coming up with an IPO, okay, selling their shares. Other way is to basically raise money from the market, okay, which is kind of debt, okay, which is nothing but a loan. Now, when I'm talking about loan, I can either go to a bank or a lender to get the money, or else I can basically issue a paper, which is a bond, which is also a debt, okay. I can issue a paper to the general public, okay. So bonds are nothing but loans taken by large companies, okay. Government also take loans. So there are government bonds. Government of India, if they want to come out with say big highways, they will borrow money through issuing a bond, okay. So there are corporations, cities, national government, they also raise money through bond, okay. But what is this bond? It's a paper, okay. Theoretically, this is the bond document, okay. It's a piece of massive loan, okay, that any person or any company has taken, okay. That's so the size of these entities requires them to borrow money from one or more sources. What does it mean? Every organization, when they're raising money, okay, so they will, some portion they will raise money from bank loans, some portion they will raise money through equity, but there is going to be good amount of portion which is also going to be raised through bonds, okay. And bonds are nothing but fixed income instrument, okay. Why? Because initially when the bonds were started out, they were fixed coupon or interest that were being paid, hence the name came out as fixed income investment, okay. So general name for the bond is fixed income instrument, okay. Now this is a pure basic introduction about what exactly is a bond. Now few example and references are here. Now think about this. There is a bond issuer, okay. Think of it like a company called DMart, okay. They want to raise more shops, okay, more DMart stores. They need money. They have already done IPO, they have already done equity. Now they want to raise the money. What they can do is they can go to normal people like you and me, investors in the market, okay. They can issue a bond. When they issue a bond, okay, the DMart as a company will become the bond seller, and the investor who are purchasing the bond, they are called as bond holders, and the bond holders will pay the money, okay, to the bond seller. And what bond seller or DMart will confirm that, okay, after every month, every 6 months, every year, whatever that is written in the contract, I will pay you coupon, which is the interest component, and at the end of say after 10 years, 15 years, I'll pay you back the entire amount. So there is some regular cash flow that is called as coupon that has to be paid. This is the responsibility of the bond seller, okay. This is the responsibility of the bond seller, that yes, I'll be paying you some amount, okay, which is generally percentage, okay, the fixed coupon, okay, I'll be paid to you every year or every 6 months, which can be semi-annual, okay. This is a very basic example. Now when you open the book, okay, this is the first thing that you will see, okay, which is nothing but how does bond trading happens, and explain a behavior of a yield, okay. Yield means interest. Now to understand that, okay, first you'll have to understand that bonds are not traded on stock exchange, okay. They are generally traded in the market, which is the OTC market, where suppose you are sitting here, okay, you are actually buying or selling the bond, okay, through a market maker, okay. Now who is a market maker? Market maker is somebody who is ready to buy, ready to sell, okay. So suppose we are talking about a DMart bond, a 10-year bond, okay. Now, when you go to market maker, you tell him demand bond 10-year, for example, he will give you two prices. Okay, let us assume that those prices are these 10 and 12. Okay, but ideally, when you go to buy anything, okay, you don't get two prices. Now, over here, why is it giving you two prices? Okay, because one price is the bid price, the other price is the ask price. Ask price is also known as offer price. Okay, now what is happening over here? So if you, what market maker is thinking, okay, so if you want to buy that bond, okay, market maker is saying you have to pay how much? 12. So you are buying and he is selling. Okay, market maker is selling the bond, you are buying, so you have to pay 12. Now suppose you also have that bond. Let us assume that you're not buying, you want to sell the bond. Okay, you already have the bond and you want to sell it. So what market maker is saying, oh, if you want to sell, then you will only get $10. You will only get $10. So do you realize there is a difference of $2 in between? That is a spread, also known as bid ask spread. Okay, this is the profit which the market maker is actually making. Okay, now why a market maker should be making profit? Because see, think logically, market maker is adding liquidity to the market. In a simple language, whenever I wanted to buy, he was available to sell. Whenever I wanted to sell, he was available to buy. Right? So he is providing liquidity to the market because I do not have to go and find any other counterparty. I directly can go and do a transaction with him. Right? So he is providing liquidity to the market and hence he should be compensated for that liquidity. And how do we compensate? Okay, the difference of price, that is bid price and the ask price. Correct? Okay, I'm taking a pause. Any query, any confusion till this point? All good? Prashant, Amit, Ajay, Acheka sir. Very basic, okay? Moving forward, okay? Now look at this. What will happen? If suppose there is huge buying pressure on the demand bond, that means everybody wants to buy, okay? And everybody is going to the market maker and there is no one market maker. There can be multiple people in the market who are willing to buy and sell, okay? If there is huge buying pressure, what will ideally happen? This ask price, this will go up. Okay, why? Because now market maker is realizing there is a huge demand for this product. I should not be selling at 12, I should be selling at 14. Okay, so there is a pressure. The spread is increasing because the ask price is going up. Okay, ask price is going up. Similarly, suppose if there is huge selling pressure, okay, that means everybody is coming and selling that bond to the market maker. So what market maker is thinking, now if everybody is coming and selling me the bond, why should I buy at 10? I should be buying at 9. Okay, so the spread will increase. Now what I'm trying to highlight with both the things, constantly there is trading happening in the market. Okay, somebody is buying, somebody is selling. Okay, so the spread will fluctuate. It will keep on fluctuating. It will not be constant. Okay, because the ask price can go up and down, bid price can go up and down depending upon the requirement. Okay, the trading will constantly happen and has an impact on the bid and ask spread. Okay, this is the basic discussion point with respect to market maker. Now, liquidity and yield. Okay, first we need to understand what is the yield. Yield, you can think of it as how much interest I'm going to earn. Okay, let me give you a very simple example. Okay, which means suppose I have an ICICI Bank bond. Okay, it is a 10-year bond. Okay, the yield is around 10%. Okay, yield is around 10%. Now, and I'm comparing my bond, my ICICI bond with a government bond with the same maturity. So government is also 10-year bond. Okay, and let us assume that the yield is 7%. So what is the difference? This is a spread. This is generally called as credit spread. Credit spread. Okay. Now why do we call it as credit spread? Because it tells me what is the gap between the interest paid by the government bond, which is most secure, and your bond, ICICI bond. Now think logically, if the gap is more, that means market is perceiving your bond more riskier as compared to the government bond. If the gap is smaller, the market is going to perceive your bond, okay, as less riskier. Right now? Logical? right? Now, how does this yield come into picture? How did we got this 10%? Okay. So let us assume that the price of the bond was 100. The income, which is the coupon, is 10 because the coupon is fixed on the bond. Okay. The yield comes to around 10 divided by 100, 10%. Now the current price is 100 and that's why the yield is 10%. If suppose there is a good news about ICICI, what will happen? The price will go up. Now the price is 110. Income is fixed because it is decided at the time of the start of the bond. It will never change. Okay? I'm taking an example of fixed coupon bond. Okay. So price goes to 110. The income is fixed. What is going to happen to the yield? Okay. Yield will go down. So see, the price is going up, yield is going down. Inverse relationship. Okay. Now what will happen when the yield is going towards 9.09%? This spread will become smaller. Okay. That means whenever there was a good news about ICICI Bank, okay, price went up, yield went down, and the spread decreased. Okay, spread decreased. Similarly, if there is a bad news about ICICI Bank, what will happen? The price of the bond will go down. This is same. Okay, what is going to happen to the yield? Yield will increase 11.11%. The spread is going to increase. Okay, spread is going to increase. Right? So in a simple language, what is happening over here? If the risk for the ICICI bond is increasing, what will happen? The spread will increase because the yield is going towards 11.11. Why? Because the price is going down. So in simple language, when the risk increase, the spread will increase. If the risk goes down, the spread will decrease. Correct? Correct. Now, this spread, which we talked about from the perspective of credit risk, also connects the concept of liquidity. Now, what is liquidity? Liquidity means ability. If there is high liquidity, you have the ability to buy and sell that asset faster because there are people in the market who are willing to buy and sell. If the liquidity is low, okay, Sahil, if the liquidity is low, it basically means there are very few buyer and seller. So even if you want to sell, there is no buyer available. So that is problematic for you. So logically, higher liquidity means lesser risk because there are more people to buy or sell, correct? So higher liquidity means lesser risk. That means the spread should be lower. Okay. If the liquidity is lower, okay, that means there are very few people to buy and sell. The risk is higher. When the risk is higher, the spread should increase. Is everybody with me till this point? Simple, Vikram, Shweta. Vikas, all good, okay? So there is an inverse relationship between what? When the price goes up, yield is decreasing. When the price goes down, yield is increasing. And it is also visible here. It is also visible. See, when the price went down to 90, when the price gone down, the yield increased to 11.11%. When the price increased, the yield decreased. Inverse relationship between the price and the yield. Okay. So this is the first learning objective. Okay. First learning objective where the focus is on understanding the bond trading, and how does the bond trading, buying and selling, okay, impacts the yield, okay, and the spread. That is the first part. Okay, very, very basic, simple. Now, the second learning objective, before we start the second learning objective, there is a one word that they've used which is called as bond indenture. Okay, it is nothing but bond document. Okay, because what is happening, you are actually, suppose we have our friend Shraddha. Okay, Shraddha has purchased a bond of Yes Bank. Okay, what is happening? She has given a loan to Yes Bank. Okay, and that bond indenture is a document which is the agreement of that loan. Correct? Now, what is happening? Yes Bank has taken this loan or bond, issued a bond to thousands of people. They cannot have an agreement signed to everybody, no? So what they would do, they will have one master agreement, okay, which is the bond indenture. okay, which is available with the corporate trustee. Okay, and this is the one document, but everybody who is buying the bond, they will get a receipt. Previously it was a physical receipt, now it is digital. Okay, so that receipt, okay, is connected to that bond indenture. It tells you who has purchased and who has not purchased. Okay, but the main document where all the legal terms and conditions are written, that is bond indenture. And those terms and conditions which are written in the bond document or bond indenture are called as convenants. Okay, are called as convenants. Some are positive convenants, some are negative convenants. We're going to be entering now in that concept. Okay, chalo, what is bond? Corporate bond, it's nothing but an instrument, a document, okay, that obligates the issuer. DMart or Yes Bank is the issuer, that okay, I'll take money from people through the bond and I will give them specified percentage of the bond par value. Now, what is this of the bond par value? So to understand this, look at this example. Okay, there is Yes Bank. Okay, Yes Bank has issued the bond to Shraddha. Okay, and Shraddha has given $100 million as the principal amount. Okay, now when this bond document is coming, okay, it will be written in that bond document. What was the par value? Okay, say par value was 1000. Okay, so coupon is going to be paid, say example 10% every year. Okay, so 10% of 1000, that is 100 rupees. That is a coupon that will be paid to Shraddha. Okay, but look at the numbers now. This means for every 1000 rupees which Shraddha has invested, 10% of that will be paid as coupon. Shraddha has paid $100 million. So she will be getting $10 million every year. Correct? 10% of that. Right? Each one bond is $1000 par value. She has purchased huge amount of money. She has invested huge amount of money. That's a different case. Okay. So bonds par value, which is 1000, some percentage of that par value will be paid to you every year at a fixed date. It can be an annual bond, once in a year the payment can happen. It can be semi-annual bond. Okay, now what is semi-annual bond? It is like this. If the promised interest rate is 6% and the par value is 1000, so ideally 6% of that, that is 60, is what I'm supposed to pay you. But because it is semi-annual, I'll pay you 30 and then 30. Correct? If it is annual, I'll pay you entire 60 in one go. Right? All of this is written where? It is written in the bond indenture. Okay? The promises of bond issuer and the right to the investor, everything is written down in this contract. Okay? And whatever is written, the terms and conditions are called as bond covenant. Okay? Bond covenant. Okay? I'm taking one more pause. Any query, any confusion till this point? All good? Chalo. Suppose, look at the example. A lender A lends $1 million to a particular company. Okay. And because the company is slightly riskier, they are saying, okay, we are okay to give you 7%. Okay. 7% rate of interest. Now read the next line. If there are no covenant, the company can immediately borrow $10 million from another lender. Now what is happening? Okay. To understand this concept, okay, suppose how does bond covenant help you? Whoever was the lender A, okay, if he has given $1 million to the particular company and he has not written anything in the contract, what will happen? The company can issue one more bond to new borrower, which is say lender B. Now what is going to happen? The risk of the company is increasing. If tomorrow the company does not have enough money to pay, okay, they will not be in a position to pay the lender A also, right? They will not be in a position to pay the lender A also. So what ideally companies do, or what ideally lenders do, if I am issuing a bond and bond is very big, okay, in the contract there will be a covenant mentioning, okay, there can be variations, but generally it is mentioned that till the time you pay this bond, you cannot issue a new bond. You cannot issue a new bond. Okay. A lender A, it set a debt restriction. Okay, there can be variations also. Like for what is debt restriction? Suppose a lender is saying, okay, you have borrowed $1 million from me. If you want to borrow again from somebody, maximum you can borrow is $5 million. You cannot borrow more than that. So I have put a restriction on the company, and everything is written on into the covenant. Why? Because I do not want this company to take more risk because I have already given you the money, right? That is what is being given, because if the company keeps on taking more and more debt, there is higher possibility that they will not be able to pay the original lender, which is A. But how do we make sure that whatever is written in the contract is actually being followed? Because see, I am a normal investor like you and me. Okay, Shraddha has invested some money. She cannot keep on tracking that particular company, right? So there are corporate trustees. Generally, these trustees are banks, big names. Okay. Now, who appoints the trustee? The company itself. Suppose if DMart wants to raise money through bond, they will appoint the trustee first. Okay, and they will pay to the trustee. But trustee's responsibility is to make sure that whoever are the bond holders who are taking money, okay, who has basically invested money, okay, they or everything that is written in the contract, in the bond indenture, has to be followed. Okay, if there is annual monitoring of the company, then reporting to the bondholder, okay, everything has to be done by the corporate trustee, and there is a fee that is being charged. Now, one interesting aspect, there is a word called fiduciary capacity. So a corporate trustee, okay, is going to be sitting in the entire structure and going to behave on behalf of the bondholder. So he will always think what is in the best interest of bondholder, and whatever is written in the indenture, is it actually being followed or not? Okay, it has been actually followed or not. That is the role of corporate trustee. Okay? Now, few basic examples which I got on the internet, so I just picked up the example. Okay. Now, the corporate trustee must be competent and financially responsible. That means you cannot hire anybody as a corporate trustee. Ideally, somebody who has a name in the market, brand in the market. Okay, that's why I said banks. Okay, because they have other brand name to lose, right? So they will not do anything wrong. So in US market, if you're raising bond, if you're raising money in the public market more than $5 million, you need to have a corporate trustee. Okay, you need to have proper documentation and everything in the market. Okay, now few of the work that ideally the bank, the bond trustee is supposed to be doing. Okay, acting on behalf of the bondholder in certain situation, monitoring the issuer to ensure that the issuer is not breaching any of the rule. What does that mean? Suppose it was written in the contract that I'll pay interest on 1st of June. So whether the interest is getting paid to the 1st of June or not. So whether there is a breach, okay, whether he is in a position to pay the principal and the interest amount back to the bondholder. Okay, if in the contract it is written, okay, that till the time the bond is active, okay, this asset or this property, the issuer has to maintain this property. So are they doing that? There are going to be checks, right? And every 6 months or every year, the information will go to the bondholder that this is what is happening in the bond. Okay, what is the status of the covenants? Okay, a communication basically goes to the bondholder from the corporate trustee. Okay, so that is the basic discussion point with respect to corporate trustee. Few examples of covenant. Now, before we go here, any query, any question till this point? Any query, any question till this point? I hope everybody is doing good. Now, let us go to covenants. Okay, positive covenant, negative covenant. Now, think of it like this. Negative covenant is something which the company cannot do. Okay, positive is something which the company is expected to be done. Now, first let us look at positive covenant. Okay, what is the first one? This is just an example. Okay, there are many, there can be many. When you read the bond document, you'll find unique covenants also. But the main thing that you need to remember is something which the company is expected to do. pay the coupon and interest on timely basis, okay, do the proper financial statements filing to the regulator, okay, carrying insurance on the asset. Suppose I'm issuing a bond and there is an asset which is based on that bond, okay, there is an asset, you have to make sure that the asset is proper, na? So you have to take insurance, you have to do maintenance, right? So all of this comes under the positive covenant. Ideally the bond issuer is supposed to take care of that. In some cases, okay, suppose I am issuing a bond to open up a factory, okay, that money should be only used for opening up the factory. I cannot use it for any other purpose. That will be written down in the contract, okay. What is negative covenant? There are some restrictions that I will put, okay. For example, in the covenant I have written till the time the bond is active, okay, there cannot be any merger or acquisition. I cannot sell this business to somebody else, okay. If, for example, the payment of coupon is not done on time, what will happen? There will be restrictions on dividend related payment. That means you cannot pay to the shareholder first. First you'll have to pay us. If you do not pay us, you cannot give dividend. Correct? Restrictions on financial activity, sales and leaseback transactions. So there could be restriction that, okay, there is a particular property, and that property is attached to the bond, and it is written in the bond contract that till the time the bond is active, you cannot lease this to somebody else. You cannot sell this property. So negative covenant, I am restricting you to do this. Okay, I cannot ask you to take this. In a lot of cases, suppose you have taken a home loan. Home loan is a very basic example. Suppose I have taken an educational loan and I have given my home as a collateral. I hope everybody is able to understand. My home is a collateral. So what will happen? The lending company will put a lien on the house. That is called first lien. Basically, when they're putting a lien on the house, they are saying if tomorrow this house has to be sold, we have to be informed first. Because we have given some loan on the basis of this house, right? So similarly, they can put a restriction on limitation of liens also. That means if there is a property, for example, okay, for example, okay, you cannot, suppose the property is for 100 crore rupees, okay, and we have issued a bond of say around 50 crore rupees. So what we can say, okay, you can issue, we have put a first lien, but you can give this, you can borrow one more amount of loan from this, on this property of say 30-40 crore rupees, okay, and that part can only be done for one time. So you can only put one more lien, second lien only. You cannot put third lien, fourth lien. In simple language, you cannot use the same property to borrow more money. That is what they are saying. Okay, so there is some positive covenant, there is some negative covenant that has to be managed. Okay, any query, any confusion till this point? Any query till this point? All good? Look at the next learning objective. What is a bond classification? Okay, so we are basically bifurcating the entire bond on the basis of different section. Okay, on the basis of different section. So look at the first one. I'm classification on the basis of who is issuing the bond. Look at the section. Public utility. Okay, then you also have transport, industrial, banks. What is public utility? Any idea? Can you give me some example? Electricity, water, yes. So there can be these companies who are issuing bonds. Yes. Municipalities could also be come into here. Transportation companies, you have FedEx. Okay, they want to raise money for new, they're buying new ship. They need money. DHFL, good. Industrials, Reliance, okay, is very good example of this. They want to set up a new factory. They need money. Banks also need money. Yes Bank, all of these. Okay. Finance company, okay, housing loan company, HDFC, not the bank, HDFC, which is now merged. The original HDFC, if they need money because they want to give home loans, they can issue a bond to get the money, right? Next is international or Yankee issues. Basically, there could be international companies raising money in India. So the first section is nothing but I am bifurcating the entire market is on who is actually issuing the bond. Similarly, I can also bifurcate, okay, the bond market, the entire market, on the maturity, short term, medium term, long term. Okay, now definition can be varied. Short term can be say three years and lesser. Okay, medium term is 3 to 5 years, and long terms are greater than 5 years. Okay, so basically I can also bifurcate the entire market based on the maturity. So I've created 3 buckets: short term, medium term, and long term. In some other country, it can be 4 buckets, it can be 5 bucket also. It doesn't matter. What they are trying to highlight is I'm just showing you the overall bifurcation of the market. Okay. Interest payment classification. So there are certain bonds, okay, who are going to pay a fixed coupon. That's why they call it straight coupon or fixed coupon. Okay. Next, zero coupon. There are certain bonds who don't pay even coupon. There is no interest paid. Okay, directly they are not paying any interest. And there could be floating rated bonds also. Let us go in detail. Okay. So first is straight coupon bond. Now this is very simple, basic, fixed coupon. So when you purchase a bond, you know every year this time you're going to get this much amount of money. And it is fixed for the life of the bond. Okay, there is no variation. Okay. Suppose Goldman Sachs has issued a 10% note. Note is nothing but a bond only. Okay, generally the maturity is lower. Okay, the bond carries a coupon of 10%, and what is the par value? $1,000. Okay, so $1,000 means 10% means $100. But what is written in the contract that I'll be paying it semi-annually. So $50 on 15th of January and the remaining $50 on 15th of July. So it's a semi-annual bond. It is 10% semi-annual bond. Even though you see it as 10%, you know it is 100, but it is not paid in one go. It is paid as 50-50. And this is the normal bond, normal type of bond that you see in US market. Okay, US market, which is a semi-annual. Annual bonds mostly, okay, are generally seen in European market. Semi-annual are mostly seen in US market. Okay, this is the first reference, which is a straight coupon bond. Next is floating rated bond. Okay, now when you're saying that it is floating rated, it means it is based on something. What is that something? Something is nothing but a reference rate. Okay, there can be a LIBOR, there can be federal fund rate, there can be Singapore interbank rate, there can be SOFR, okay, which is secured overnight funding rate. The various reference rates are available in the market. How does it work out in a floating rate? I'll give you an example. Suppose, okay, I have purchased a bond, which is a 10-year bond, and it's a floating rated bond. Okay, and let us assume the rate floating rated, na? And the par value is say $1,000, and it's a 10-year bond now. So and the payment is done every year. So this is time 0. This is where I start the bond. Now while buying the bond, I know what is the 1-year rate, because from today it is 1 year. Okay, when the bond is issued, you know what is the 1-year rate. Let us assume the 1-year rate is 7%. Okay, you are aware about this at time 0, but you will be getting the coupon over here. How much coupon you will get? How much coupon you will get? $70, na? Now, when you reach at time 1, you will get that 70, but on the same time, you will also come to know what is the next annual rate or next year rate. Okay, suppose that rate is 8%, so you will get 80. When you reach at time 2, let us assume the next 1-year rate is 4%, so you will only get $40. So it is fluctuating. That's why it is called as variable. There is nothing fixed, right? It is fluctuating. So remember that always. Okay, 70, 80, 40. Okay, let us go back to the PPT. Okay, floating rated bond, also known as variable rated bond. Now, how do I know that 1 year rate? So in my example, okay, what I can do when I was standing here, I'm going to look at what is a 1 year LIBOR. Let us assume it is written in the contract that the rate that is based on is LIBOR. Okay, so LIBOR rate is 7%, so I'll be getting 7% next year, which is 70. If the 1 year LIBOR rate, when I reach over here, 1 year LIBOR rate is 8%, so 8% of $1,000, 80. Likewise, it will work. Okay. Now it is not necessary that it is always going to be the same. For example, suppose I issued a floating rated note, and in the contract it is written LIBOR plus 100 basis point. What is 100 basis point? Any idea? क्या हो गया guys? Any idea? 1%. Yes, 100 basis point is 1%. So if my LIBOR, I'll just change the color. If my LIBOR is 7%, so it is going to be, LIBOR is 7%, I'll be paid 8%, LIBOR plus 1%. If it is 8%, I'll be paid 9%. If it is 4%, I'll be paid 5%. Likewise. Okay. So this is just an example. Okay. Zero coupon bond, mark it as star, important. Okay. Important. Now to understand zero coupon bond, let me give you an example. Suppose time 0, time 10 years. Suppose it's a 10-year zero coupon bond. Okay. And at the start, okay, you have to pay 90 rupees to purchase the bond. And in the bond it is written, I'll not pay anything in between. Everything will be paid to you at time 10 and you're going to get $100. So do you realize you paid 90, you're getting 100. For every 1 year, $1 is getting accrued. When you complete 1 year, that $1 is getting accrued. Ideally, it was supposed to be paid to you, but it's a zero coupon bond. So what they are saying, we are not going to pay you now, we're going to pay you later, along with the final amount. So every year, $1 is getting accrued. And when you reach at time 10, you get ideally $90 plus that $10. $90 plus that $10. That $10 is the interest. So this is the discounted price. This is a discounted price at which you are buying now. And you are getting the face value. This is called as face value. $100, which you will get at the maturity. But you know that out of this face value, $90 plus the interest is what I'm actually getting. Okay. So this is a very simple example of a zero coupon bond. Okay. Zero coupon bond pays the face value or the principal at maturity. Okay. Let us assume, okay, this example, a bond has a face value of 20,000 and going to mature in 20 years with a yield of 5.5%. Okay. Maybe purchase roughly for this. So this is the amount, okay, you are actually paying right now, 6,000 something. At the maturity, you're going to get 20,000. At the maturity, you're going to get 20,000. So what is the actual interest that you've earned? Okay, it is at 13,000 something, the difference. That is the interest that is automatically getting accrued, but you're paid only at the maturity. I'm taking a pause. Any query, any confusion till this point? And I'm answering to the query. What is the benefit of a zero coupon bond? Is it similar to FD? No. So companies, when they manage their asset liability management, okay, if I have borrowed money, okay, at a particular, so think of it like this, I want to match my asset to my liability in such a way that I exactly know that the amount is going to come back at a particular time. For example, okay, suppose I've raised money through my liability for 5 years. I want to make sure that the exact same amount comes to me after 5 years, so I can invest into a zero coupon bond accordingly. Okay, and overall interest will be higher than what I am actually paying. That is how I am going to make money. Because I have answered your query. Look at the example. This example, it's a 5-year bond. Original issue price or the offer price is 90. What is the overall discount you're getting? 10. Why? Because the face value is 100. So now you're getting a discount of 10 and you're only buying at 90. You're only buying at 90. Okay. Now, just connecting the same example, look at this. So ideally, you're paying 90 and every year $2 is getting accrued. You're not going to get that amount. Okay. When you reach at the maturity, you get 100. That's 100 is nothing but 90 plus that $10. That $10 is getting accrued every year, $2. That is how the zero coupon bond actually works. So in between, they are not paying you anything. They are not paying you anything. Straight away, they will pay you at the maturity. Now there are few questions, a few understanding which you need to be clear about the exam section. Okay. Now think about this. If the zero coupon bond issuer defaults, okay, you have paid 90, okay, today, okay, and you are expecting I'll get 100, but after 2 years, okay, the company defaults. Then what will happen? After 2 years, the company default. So you will only get the original price that you paid plus whatever is the accrued interest. So you will only get $94. Okay, you'll only get $94. You will not get 100 because the interest was not accrued. Correct? The interest was not accrued. It was only $4 that was accrued. So from that perspective, this is the case. Okay. I hope everybody is reading. Let us move forward. Now, one interesting aspect that you need to remember, whenever the default has happened, whatever is the original price plus the accrued interest that has been paid to you. Now, one more connecting point over here is, okay, the rate of return depends upon, okay, what is the amount of discount and the period over which it is growing. Okay, these 2 points are also important to understand. Okay, now let us go in detail with respect to the number. Okay, so if you continue with the example which has been mentioned, time 0 you paid 90, time 5 years you're getting 100. Okay, now if somebody asks you how much interest you have earned, okay, so what is the discount that you're getting? Discount you're getting is $10. So it is going to be 10 divided by 90. Okay, because you have invested only 90. Correct. So you're going to make something like this, 11.11% something. Okay, this is the interest that you're earning. Now think about this. If I change the number, I can change it in two ways. If I change the entire thing, I can change it in two ways. Suppose instead of 90, I put 80. What will happen to this 11.11%? Will it go up or will it go down? Will it go up or will it go down? It has to go up, right? Because the denominator is becoming smaller. But think logically, if my discount amount, which is 10, which increased to 20, automatically my interest will also shoot up. So it depends upon how much discount I am getting. In this case, it was 10. Logical? Now, suppose if I keep this as 90 only, okay, but instead of 5 year, if this is increased, your overall return will come down. Why? Because previously, the difference of 10 you were earning in 5 years, now it is taking 10 years. So your return will go down. Correct now? Yeah, yes, the tenure increase is a problem. Actually, now you're saying I have to wait for 10 years. Previously, it was only 5 years. So your overall return depends upon two things. What is the amount of discount you're getting? What is the gap? 10 or 20, 25? What is the gap? Okay. And for how much period it is? Both of them is going to impact your overall rate of return that you've made on the bond. Correct? I'm taking a pause. Is everybody okay on these 2 points? Everybody okay? Let us move forward. Now, no reinvestment risk. Now, what is reinvestment risk? See, whenever I buy a coupon bond, which is going to give me interest, okay, what is the risk that I'm facing? That suppose when I started the bond, the rate of interest was 7%. Okay. Now, and when you're purchasing the bond, you're saying, okay, rate of interest is 7%. I'll keep on investing at 7%. But now, after some years, the rate of interest has gone down. So, what is the problem? Whatever cash you're getting in terms of coupon, okay, you have to reinvest that money at a lower rate. Previously, you were reinvesting at 7%. Now you have to invest at 3%. So there could be a risk, which is a reinvestment risk, which you're going to be facing. Okay. But after that, okay, in a zero coupon bond, there is no reinvestment risk. There is no reinvestment risk. Why? Explicitly, because the problem that you're facing, there is no problem over here in terms of cash coming in, because there is no cash in between. In a zero coupon bond, in a coupon paying bond, the cash is coming in between. Now you're thinking where I have to invest this into market. But in a zero coupon bond, there is no cash coming in. So there is no reinvestment risk for you, right? Right? No reinvestment risk that you're facing in the zero coupon bond. But in certain countries, okay, see this logic. It is possible to convert the bond interest income as capital gains. Now, why are we saying this? Okay. If you are having income, your tax is different. If you are having capital gains, your tax is different. Generally, capital gains are taxed at a lesser amount, lesser percentage. Okay, now think about this. If you are in US, for example, and over there, whatever income you are getting every year from the bond, okay, a zero coupon bond, okay, that is not treated as an income. Okay, it is actually treated as a capital gains, and the taxable amount will come lower for you. Correct? Taxable amount will come lower to you. So what the government might say, they might say, see this. Oh, you had paid 90. Every year the price of the bond is increasing by $2. That is capital gain, capital appreciation. In some country, this will be treated as an income. In some country, this will be treated as a capital appreciation, and you have to pay capital gains. So the taxes on capital gains are lesser as compared to on the income. That is why this line has been added. Okay. That is why this line has been added. Okay. I'm taking a quick pause. Any query, any confusion till this point? Swara, answering to your query, I didn't see the chat actually. Are zero coupon bonds more riskier? No, we cannot say that. It's not like that. Okay. One thing that can be connected to your question. See, in zero coupon bond, what is happening? I'm going to get entire money at the end. In coupon paying bond, at least I'll get some coupon in between, right? So the risk could be that at the maturity, I'm expecting a full amount from somebody. If he defaults, there is a huge problem for me. That is the risk that I can face. Okay, Swara, I've answered your query. Right? Now look at this example. Chalo fast. Subodh, till that time I'll answer the question to Subodh. Subodh, no reinvestment risk because there is no cash flow coming in between. When you have cash flow coming in between, you're worried that how this amount will be invested in the market. Okay, because if the interest rate has gone down, you have to reinvest at a lower rate. Correct? So there is no risk in zero coupon bond because you're not reinvesting anything. Look at the question, everybody. Okay, everybody is saying A. A trustee takes reinforcement action in the event of the payment default. Yes, because he has the fiduciary duty. Trustee is responsible for verifying and authenticating the issue of the bond. Yes, that is the main responsibility. He's there, he's sitting so that the bond issuer, they are not worried about it. Okay, they are not worried about the issue, right? Trustee represents the interest of the bondholder in a fiduciary role. I just talked about this. All of this is correct. The first point is wrong because bondholders are not directly paying. Who is paying? The bond issuer, right? The bond issuer. What are the different types of bond? Answer is A, huh? What are the different types of bond? Chalo. First, now before we go into the main section, I am going to basically explain what is collateral. Okay. Suppose I have placed a bond, okay, and there is an asset okay, which is basically a collateral for the bond. Okay, now when I'm selling the bond to the bondholder, I'm basically saying that if I'm not able to pay you anything, you can take the control of the collateral, you can sell it, you can liquidate it. Okay, so that is how the collateral work. So collateral is very useful because it reduces the risk. If I am issuing a bond and I'm saying I have a property in Mumbai, okay, which is of 50 crore rupees, which is a collateral. If tomorrow I'm not able to pay, take the property. It is written in the contract, right? So defaulting firm will be liquidated. Okay, the sales proceed will be from the collateral will be the paid first to the bondholder who have a collateral position, right? So whenever the company is not in a position to pay, company will be liquidated, but that first asset, that collateral, whenever it is sold, the money is first paid to the bondholder. Okay, money is paid to the bondholder. Very interesting, right? But look at one more point. If the defaulting firm is reorganized, what is reorganized? Restructuring. Okay, company is getting restructured. They're closing some businesses, some division. They are changing the company names. So many things can happen in restructuring. The bondholder who has the control of the collateral, they can have good negotiating power. Okay, because as per the contract, as per the bond contract, this is the collateral. This property was a collateral which was there with the bondholder. Correct? So it can give you more power when you are sitting in the firm in terms of negotiating because the company is getting restructured. Now, why did I explain you about this collateral part? Because there are four important types of bond. Okay, the mortgage bond, collateral trust bond, important. Okay, and these equipment trust certificate, important. Okay, so all of this depends upon the collateral. Let us look at the first one. What is this mortgage bond? Okay, now what is mortgage? Very simple. There is either a equipment or a property of the firm which is kept as a collateral. Okay, generally these are secured bond. When you are saying secured bond, the bond is secured with that equipment. Bond is secured with that property. Okay, tomorrow if the bondholder, bond company or the company is not in a position to pay, the equipment or the property will be sold and the money will be first paid to the bondholder. Okay, now there are two important points, okay, that are generally added in the clause. Okay, when these kind of collateral will come. Okay, look at the first one, restriction on future bond issue. Now suppose if the property was worth $100 million and I've already issued a bond of say $70 million. So what the bondholder can say that because the property is worth currently $100 million, you cannot use the same property to issue one more bond. That is restriction that I have put in. You cannot use the same property to issue one more bond. Interesting, right? And the connecting aspect is after acquired clause. Okay, which is nothing but because I have entered as a bondholder. Okay, I have the first right on the equipment or the property. If tomorrow it is sold, okay, I'll have the first right whenever the property is sold and I'll be paid first. Okay, I'll be paid first. And most of the time, this after acquired clause is also connected with the restriction part. So because I am the bondholder and the collateral is that property, okay, I can put some restriction on the overall property that you cannot use it. You cannot, for example, you'll have to maintain the property. You will have to, you cannot use the same property for new bond, new loans, or all of these things. So I can put restriction because I have entered. After I have acquired the bond, you cannot do XYZ things. Okay, this is the first type of bond, which is a mortgage bond. Okay, and I'm assuming people are reading the textbook along side by side. Okay, if they've already seen the video, they've already read that book, they'll be in a position to connect what I'm talking about. Okay, collateral trust bond. Now this is very interesting. Okay, mark this as star. Collateral trust bond. Now most of the time in this case the collateral is not a equipment or is not a property. Okay, it could be bonds or stock. Now I have also written personal property. This is the proprietor's personal property, not the company, proprietor who is the owner. Okay, but most of the time it is some financial instrument, some bonds, some stock. Now what is happening? What is the interesting part over here? Think about this. Suppose we have Aryan who has purchased this bond. He is the bond holder. Right, Aryan? You are the bond holder. And there is stock which is currently valued at $100 million, stocks and bonds, which are this collateral. Okay. Now, and which is the company? Say company XYZ. Okay. And they have issued their subsidiary company stock or something like that. Okay. Which is over here, stocks and bonds and all of this. Or you can think of it like this also. I'll just change the example. This XYZ company has purchased huge stocks of Tata Group. Okay, Tata Group, and that is kept over here in the as a collateral. Okay. So who is going to hold the collateral? It is the trustee who will have the collateral. Because suppose if tomorrow the company collapses, XYZ company collapsed, okay, the bond holder Aryan, he will have to go to the company to get the collateral. It is not safe. So they keep the collateral generally with the trustee because these are financial instruments. An important point over here is voting right. Now think about this. If this XYZ company has a 5% shares of Tata Group, they have the voting right in the Tata Group. So whenever I am putting that as a collateral, I am only keeping that asset. I am not losing the voting right. Do you realize this point? So whenever there is an annual general meeting of Tata, XYZ company can go and vote. Even though the asset is kept over there, the shares are kept. When you become the shareholder, you get the voting right, na? I hope everybody is aware. That is how you decide what is going to happen in the company. Right? Now think about this. Now, if I am a big shareholder of Tata Group and I wanted some money, so I pledged my stocks. Okay, it does not mean I am losing the voting right on the Tata meetings. It has just been kept as a collateral. I still have the voting right. Okay, this is a very important point. Next is what will happen if the value of the collateral goes down. If suppose tomorrow the Tata stocks goes down. Initially when the loan bond was issued, the value of this entire pool of bonds and stock was $100 million. But now the market is down, the Tata Group stocks are down. And this is only $70 million. So what will happen? It is ideally written in the contract that if the value of the pool goes down, okay, either you'll have to pay the money or else you'll have to add more collateral, add more stocks so that the overall value comes back to a particular level. Correct? I'm taking a pause. Read and let me know if there is any confusion. I hope everybody is reading. Give me a confirmation as you're done. How is this voting right retained? Helps to issuer. See, I'm not losing the control. Na? I'm not, see, if suppose Vikas, suppose you are the owner of the company, you have 40% share and you are putting that share as a collateral. If you lose the voting right, you will not be able to run the company. Right? So that is how the issuer actually gets the benefit because he's not losing the voting right. Correct? Because I hope the query is resolved. Now I'm going to move towards further more points. Okay? Just a connecting point. Subsidiaries, home country or foreign subsidiary, it can be any subsidiary. Not specific to Indian entity. So for example, you might have Morgan Stanley Global and they're issuing a bond and they're using the shares of the India subsidiary. That is also possible. Okay. So important thing to realize is that under a collateral trust bond, the asset pool can be a financial asset, a stock or a bond. And who has this? The trustee. It is deposited with the trustee. Same repeated points are repeated. Okay. The value of the collateral is periodically reassessed. If the value has gone down, what will happen? You will have to either add a collateral, okay, or basically put cash. Because what the bond holder is thinking, I need to be protected. Because I have given you a loan of, I have issued a bond of $70 million. I have given you the money, and if the value of the collateral goes down below 70, I am at risk. Correct? So whenever the value of the collateral falls below an agreed level, okay, either you have to put additional securities, that means additional stocks or bonds, or put cash as a collateral. But suppose exactly opposite happens. If the value goes up, then you can withdraw. Right now, if the value initially it was $100 million, it went to 120, you can withdraw 20. We are okay with it. Correct? So this is the connecting point of the collateral trust certificate. Let me know if there is any confusion till this point. Everybody, grandson? I hope everybody is doing good. I'm going to move ahead now. Equipment trust certificate. Now, when you look at the example, this will become easy. Okay, what is happening in equipment trust certificate? Now, suppose there is a company called Go Air and they need airplanes. Okay, see, normally what can happen is in Go Air can issue a bond, they can raise the money and they can buy the equipment. Then who is the owner of the equipment? Go Air, correct? But in an equipment trust certificate, what we are doing is the purchaser has decided that he will basically first create a trustee, okay, and he will pay some initial amount also in some cases, some 10%, 20%, whatever it is, okay, and through this trustee, okay, they will create a trust and this trust will issue a bond, okay, to the investor, okay, the investor will pay the money, okay, and bond holder will get the ETC, okay, and the trust is going to purchase the equipment, okay, and then the trust will give that equipment to Go Air to use, okay, and Go Air will pay every year rent. It's on lease, okay, Go Air is going to pay every year lease or rent that is actually paid to the investor. So what is so unique about this? Very important point is who has the ownership of the asset. When you look at a normal bond, Go Air has the ownership. In this case, the trust has the ownership. If tomorrow Go Air defaults, correct? Go Air defaults, trust has the complete control over the asset. They can take the asset, they can sell it in the market and give the money back to the investor. Or else they can, what they can also do is they can take the asset, okay, and they can give it, suppose Go Air has defaulted, they can take the asset and give it to Air India and continue with the payment. Okay, so the major point is the risk to the investor is very low. Why? Because who has the ownership of the asset? Trust. Okay, this is nothing but equipment trust certificate. Okay, and whatever the amount that the Go Air is going to pay every year, the lease amount, in some cases it is called as dividend. It is nothing but a rent that I am paying, lease amount that I am paying to use that asset. Okay, in certain cases it can also be the case that after a few years, after 5 years, 10 years, Go Air can pay some extra amount and take the control of the asset. That means they will buy the asset. That is also possible. But it has to be written down in the contract. That's why. Okay. I'm going to take a quick pause. Let me know if there is any confusion under this section. ETC can be a zero coupon. It can be, generally it is coupon paying bond because the rent that is being paid is passed on to the investor. Subodh, answering to your query, comparing collateral trust bond or loan against security. No, loan against security is different because you're saying you take the security, give me the loan. In a collateral trust bond, who has the securities, the asset, it is basically the trustee. That is the difference. Subodh, I have answered the query. And yes, if the value of the security goes up, you can withdraw. That is also correct. What about others? Madhav, Rahul, Shreyas, Shruti, Subita, सब है ना? Vaibhav. Depreciation has any effect? It is taken into account. It is taken. See, if it is obviously it is going to get depreciated. Okay. So what Goer, if the Goer wants to have the control of the asset later on, okay, they will pay as per the depreciated value only. They will not pay the original value, no? After ETC, there is one more section called debentures. Debentures are unsecured. That means there is bondholder who is buying the bond, but there is nothing to protect. Also called as unsecured bonds. Also called as unsecured bond. Now this is very interesting. Okay. Now the question that will come to your mind is why would an investor invest into this bond? Because the rate of interest is higher, because the risk is higher. Correct? Right? Look at this point. Rank lower than mortgage and collateral trust bond. That means, think about this. If a company, okay, suppose Subodh has a company and Subodh has issued mortgage bond also, they have issued a collateral trust bond also, and they have issued a debenture also. So do you realize mortgage bond and a collateral trust bond are secured bonds? Because there is some asset collateral. For debenture, it is unsecured. So now what is happening? Whenever the company is liquidated, okay, when you are selling the asset, first you will pay mortgage bond holders and collateral trust bond, and then they will pay to the debentures. So that is why they have written rank lower. Whenever the company is liquidated, the first payment will go to the secured bonds and then it will come to the unsecured bonds. Correct? Right? What is a negative pledge clause? Okay. Now see the negative pledge clause. Okay. I'll just connect the dot over here. Think about it like this. Think of first scenario. Okay. This is my entire company. Okay. And suppose this is the part. I'm just showing you diagrammatically. Okay. This is the part which has been given to the secured bond. That means first the company has issued a secured bond. Okay. So I'm writing first a secured bond and then after that a debenture is issued. Right. Now whoever is buying the debenture, it is unsecured. That means they are a general creditor of the company. Okay. That means they have kind of claim on everything of the company. So, but because secured bond holders came first, so they have debenture holder, they can claim only on this part of the property. Correct? Right now? Because the secured part, whenever it is sold, it will be paid to the secured bond holder. Now look at the second situation. Second situation, this is my entire company. Okay. Now, first I am issuing a debenture, which is generally not done. Huh? Companies don't issue debentures first. Okay. First, debentures are issued. That means they have control on everything. Control in the sense they have claim on everything. Now, after the debenture is issued, okay, then there is a secured bond that is being given. Suppose the secured bond is for this part. Now do you realize, okay, the debenture holders, if they are coming first, they will add a negative pledge clause. What they are saying is, because we came first, okay, and then the secured bond holders are coming in, okay, the secured bond holders are informed that if the company liquidates and this part of the company is sold, whatever amount we are going to get, okay, some portion of amount will go to the debenture holder, some portion will go to the secured bond. In the first scenario, that was not the case. In the first scenario, if this company is liquidated and this part, which was the asset which was being secured, if this is sold, the entire money would go to the secured bond holders. They will be paid first. Correct? But in this second case, where there is a negative pledge clause, Okay, why? Because the debenture holders came in first. So they are adding a clause in the contract that whoever next will come, it can be secured, it can be anybody, we will also have right on that asset. Correct? Is everybody okay till this point? Everybody's okay? Now connecting dot. Okay. This is some part is repeat. Debenture unsecured, and because there is higher risk, they are paying higher rate of return or interest. Okay. Now, generally debentures are issued, okay, by those companies which are generally high rated. Why? Because then only people will buy. Because see, when I'm buying a debenture, there is no asset to protect me. I'm looking at the company, looking at the credit worthiness of the company, and then I'm investing. So if the company is perceived as credit worthy, then only people will buy. Correct? So main point is they're looking at the rating of the company. They're looking at what is the product that they're selling, what is the company's behavior, and then they will buy financials and all of that, right? Now, one connecting dot over here is convertible debenture. What is convertible debenture? It is a debt, okay, but it can get converted into a stock. Okay, it can get converted into a stock at a predetermined time frame. After a predetermined time frame. So it can be like this: for the first 5 years, it is a bond. At the end of the 5 years, it will be converted into a stock. Okay, these are convertible bond. Now, why would this happen? Why would somebody buy a convertible bond? Now think about this. This generally happens in a startup. Okay, so if you're a company and I'm an investor, I will say I'll give you a convertible debenture. Okay, that means a debt. If we want, we can convert it into stock. That means we'll become the owner also of some percentage. So when the company is actually doing good, we would convert it into a stock. Okay, this is convertible. There is non-convertible. That means it is only going to remain a bond or a debt. Okay, exchangeable debenture are slightly different. Okay, so see, this convertible and exchangeable are convertible to the common stock of the corporation other than that of the issuer, which means I am say Tata Motors. Okay, I have issued an exchangeable debenture and it is written, if you want to exchange, it will get exchanged into a stock of my subsidiary company, not my company, subsidiary company. Okay, that is why the logic is that is the difference between a convertible bond and an exchangeable. Convertible bond, you get the stocks of my company. In an exchangeable debenture, you get the stock of my subsidiary. Correct? I'm taking one more pause. Any confusion till this point? I hope convertible is not compulsion. So it is written in the contract. Sometimes it is a date, sometimes it is based on the bond holder, that when they can convert. Everything is, there are different variations into it. Right? Let us go to the next part. Now, can you see the diagram? Okay. At the top, it is a secured bond. Okay. Then you have the unsecured debt. Then you have subordinated debt, and then you have the equity. This basically tells you that who has the first priority of repayment. Whenever the company goes bankrupt, secured debt is paid first, then unsecured debt. Okay, these are senior. Ideally, these are senior unsecured debt. Then you have subordinated. Subordinated means there is, see, when you read this section, they've written subordinated debt debenture. That means before this subordinated debenture was issued, there was already one more debenture that was issued. So the previous one is called as senior debenture. This is called as subordinate debenture. Okay, subordinate debenture. Suppose Subita, our student, okay, she has a company and she issued a debenture A. After a few years, she needs more money. She has issued debenture B. So this A, which was first issued, is a senior debenture because it will be paid first. and then junior subordinate debenture, which is called as B. Right? So if the issuer goes bankrupt, first the secured debt is paid, then within the unsecured debt, whoever was a senior, that will be paid, then the subordinated one will be paid, and finally the shareholder, the equity holders will be paid. Now think logically. If you're buying this subordinated debt, your risk is very high. Why? Because you're going to get money after secured and senior unsecured. So your risk is high, so your return is also going to be high. Correct? That is the main logic. So this subordinated debenture is explained through this diagram. Guarantee bond. Okay. So it is like this. Again, I'll go back to Tata Motors. Tata Motors is a very stable company, good brand in the market. So, and they want to start out a new startup. Okay. Tata Tech, or to say Tata IoT division. Okay. And they want to, that company wants to raise money through bond, but it has no market standing. So what will happen? In the contract, they will have a guarantee given by Tata Motors, the main company, that if tomorrow they are not able to pay, Tata Motors will pay. So now if I am the bondholder, okay, and there is Tata IoT company, okay, Tata IoT company, okay, which I am giving the money. So previously I was only looking at Tata IoT, but now because there is a guarantee coming from Tata Motors, I will have to look at what is happening with the guarantor. If tomorrow the guarantor also goes, then what? So I will also check what is the security or what is the guarantee of the Tata Motors. Okay, whether Tata Motor is credit worthy or not. So I will have to look at the ability of the guarantor also, that whether he will be able to pay me or not. Right? I'm taking a pause, answering to the query. So Vikram, this query of mezzanine debt. So senior, anything which is below the senior is called a subordinate. It can be mezzanine, it can be junior, it can be any other name. So anything below that is your subordinate debt. Can this scenario happen? First the debenture is issued, then subordinate debenture is issued, and then after secured bond? Yes, that can also happen. But there is a negative clause. Yes. See, what is the importance of negative clause? Basically, we are saying the secured bond holder that because this is used as a collateral for you, it does not mean that you will only get the entire money. We came before you, so we should also be paid some portion. Right, Vikas sir, I have answered the query. Vikram sir, I have answered the query. Security for bond section. If everybody is okay, we'll go to the next part. There is a question, which of the following best reflects the credit risk consideration of a guarantee corporate bond? Guarantee. So read all the options. A guarantee can cover the principal repayment, but it may cover the principal, but it is not allowed to include interest. Is this correct? We didn't explicitly talk about this. Wrong. A guarantee bond must be backed by only one guarantor, not necessary. You can have multiple guarantors also. Correct? Credit strength of both the issuing company and the guarantor determines the bond's overall security. Obviously, like I said, Tata IoT and Tata Motors, I will have to look at both. Previously, I was only looking at Tata IoT. Now, I will also have to check the guarantor. This is correct. Such bond completely eliminate the possibility of default. No. Because if suppose tomorrow Tata IoT defaults, Tata Motor also default, I am gone. Correct? So answer is B. Answer is B. Okay. Now we are entering into one interesting aspect, which is method of retiring the bond. What is retiring? Means I am closing the bond. Right? See, very easy way is to pay the entire amount. Okay, at the maturity. So generally the bond retires at maturity. But over here they are saying, how can I retire early? Okay. How can I retire early? So look at this. There are various provisions which are being highlighted. So we'll first go to the call and refunding provision. Okay. Now there is a call option, or generally called as callable bonds. Okay. Please listen to me very carefully. What is a callable bond? I am the issuer. Suppose you all are bondholders. I am the issuer. and I've issued a callable bond. You are aware about this, that this was a callable bond. If it's a callable bond, in most cases, initial few years I cannot call back. Say initial 3 years. But after that, I can call back the bond. I'll pay you the amount, but I will call back the bond. So I have the right. Who has the right? The issuer has the right. Okay. So generally, the call structure works like this. I'll go back to that previous slide. Okay. The bond is issued at time 0. Initial, suppose 2 years. This is an example. Huh? Okay. This is an example of a fixed price call. Initial 2 years, the bond cannot be called. And it is written in the contract that, okay, if you want to call back the bond between time 2 and time 3, you will have to pay $110. Par value is 100. You have to pay extra because you're calling early. If you're going to call back between this to this, price is going to be 105. If you're going to call between this to this, the price is going to be 102. So the fixed price call will go down. See, if the bond issuer is going to call back early, what is going to happen? The bond holders will lose the interest, the coupon. Correct? So what will happen? They are going to say, okay, you can call back the bond, but you'll have to pay a slightly higher price. Okay? Slightly higher price. Now the next question. Why would the bond issuer call back the bond? Think about an example. Okay? Suppose our student Timanshu ho na? Nahi. Timanshu? So, suppose Timanshu has purchased the bond. Okay? And I am the issuer of the bond. And I had issued a bond at 10% rate. Okay, when the market rate was 10%. Now, I have already sold the bond to Timanshu, and now the interest rate has gone down to 3%. Now I'm thinking, why am I paying 10% to Timanshu? Doesn't make sense. And I have an option in the bond, which is callability. I can call back the bond, okay, pay back the money to Timanshu. I can reissue a new bond at 3%. So my overall cost will go down. That is why generally companies do take the callability feature. That if the time is favorable for me, I'll call back the bond and I'll reissue at a lower rate. Correct? So everybody is okay? It means if the issuer is calling at initial year, he is compensating the bondholder. No, he is not exactly compensating for all the future cash flow loss. No. But what we are doing is, we are saying, oh, if you want to call back early, you will have to pay slightly higher amount. Right now? Or else why would an investor buy this bond? Correct? So everybody is okay on the callability part. Okay, many corporate bonds contain embedded option. What is this embedded? It's a call option. Okay, everything is written at the start. Before buying, you will read the document. It is written how the call will happen. Okay. Now, what is this callability feature gives? It gives the issuer the right to buy back the bond at a fixed price. Okay, either in whole or in parts. That means one way I can buy back the entire bond, or else every year I'm going to buy 20% of the bond. I can do that. Everything is written down in the contract. Huh? Either I can call back the entire, or else I can call in parts. Correct? Now think about this. If Timanshu, you get if I'm selling you a normal bond or a callable bond, which one will you buy? You buy because you are an investor. Which one will you buy? A normal bond or a callable bond? Which one would you prefer? What about others? Obviously a normal bond, because there is no risk in a normal bond. In a callable bond, Timanshu is facing a risk. No? If tomorrow the bond is called, I will not get the interest amount. I'll lose. No? Now think from Timanshu's perspective. What is happening? He invested money into the bond when the rate of interest was 10%. Now interest went down to 3%. The bond is called. He's given the money, but now he has to reinvest at 3%. No? He's losing that interest. So you would always prefer a normal bond. Correct? So what will happen? Generally the price of the callable bond is lower as compared to a straight bond, a simple bond. Vikas sir, answering to your query, whether that risk carries extra interest, if I'm buying something at a low price, automatically the yield is going to be higher. Correct? But normal also have more risk. No, I'm saying everything else is same. Everything else is same. If you get an option of normal bond or a callable bond, which one would you buy? बराबर ना? चलो, gives the ability to substitute. See, this issuer, if I have already issued at 10%, now the rate of interest is 3%. Because there is callability feature, I have the ability to pay back, get the bond, and issue a new bond at a lower cost. Right? Right? So the fixed call provision, I have shown you the example. Okay. Now, within the same thing, okay, there can also be a make whole call. Okay, make whole call. I'll come to that, but I'll just read this part, this line. This price, call price generally start at a substantial premium over par, which means if you're going to call early, you're going to pay higher amount. If you're going to call later, the amount will become smaller. Initially, you're paying 110. Now you're only paying 105, 102, and finally you'll have to pay only 100. Correct, na? So if you're going to call back early, you are actually paying a slight premium amount. Okay, and this amount will decline as we move ahead. So first it was 110, then 105, 102. And final year, it is going to be same 100, par value. Right? Now, make whole call. So what they are saying, so one option is that you have a fixed call price. At the start itself, it is written. One more option is the price is not fixed. We can calculate the price. At what price the bond can be called. So the formula, okay, generally they will not ask you the explicit formula, but you need to understand what is happening. Okay, they will calculate the present value of all the remaining cash flow. Okay, subject to the floor of par value. That means the present value cannot go below the 1000 rupees, which is the par value. If my par value is 1000, when I'm calculating the present value, minimum to minimum 1000 rupees you will have to pay. Because the bond holder has already paid the initial premium. Now, when you're going to pay back, you will check the call price. You cannot go below the $1000. You will have to at least give him back the principal amount. Right? Either this or 100% of the principal amount plus the interest, accrued. Okay? Whichever is greater, any of them has to be paid. So why this make whole call comes into picture? Because you do not, there's no fixed call price. You're actually calculating the call price when the call is decided. When the call is decided, whichever is higher, either you calculate the present value of the cash flow or you calculate the 100% value plus accrued interest. Now, what is accrued interest? Think about like this. Suppose this is the coupon date, this is the coupon date. Okay, today we are standing here and we are thinking that I want to call the bond. But do you realize for this much period, the bond is being held by the bondholder, but the coupon is actually paid here. So what we will do, we will calculate what is the accrued interest for holding this bond till to this. And that is also paid to the bondholder. That is also paid to the bondholder. So 100% of the value plus the accrued interest. Whichever is greater, that is basically becomes the call price. That is basically becomes the call price. Okay. So this is an example. Same points, connected points. Okay. I'm just taking a pause. Any query till this section? The discount rate ideally is, Vikram sir, answering to your query, discount rate is generally taken as whatever is the similar maturity treasury. We take that discount rate to calculate the present value. Madhav, answering to your query, so normal bond is better than the bond with make whole option, which in turn better than the option with fixed. See, there is nothing like that. Okay. Sometimes the fixed call price will give you better answer or better price. It is not like that. But yes, normal bond has lesser risk. Over here it is higher risk, and because it is higher risk, the price is lower. I have answered the queries. Can I get a quick confirmation till this point? Right. Next one is sinking fund. Okay. Now sinking fund is nothing but what you are doing is you are paying back some portion of the bond every year. Okay. So you are retiring a specific portion of the bond each year. Now, one way to do it is have a lottery. Okay. Suppose you all are my bondholder. Every year I will take out a lottery. Lottery in the sense I will pick out anybody's name. Suppose this year the name came as Subita and say Sahil. So they will have to give their bond and I'll pay them the bond. I'll pay them the amount. So I can also use lottery to decide whose bond will be retired. Okay, whose bond will be retired. Or else I can also make an open offer to the market that okay, I'm going to retire 20% of my bond this year. Whoever is interested, I'll pay this much amount. They can come and they can retire. Okay. So can submit cash of face amount of the bond to be retired to the trustee. Okay. So what generally can happen, if suppose I do not want to explicitly retire the bond, what I can also do is whatever amount I was supposed to give to the bondholder, I can give it to the trustee. He will invest into the market, okay, and earn some interest, and then finally at the maturity that amount is paid to the bondholder. That also can happen. Okay, so the trustee will hold that cash. Okay. Similarly, if the actual actual retiring is going to happen, okay, so I will give the money to the trustee. Trustee will give it to the bondholder. He will collect the bonds and he will give it to me, and the bonds will be destroyed. Or basically, physically, if it is there, it is destroyed. Okay. Next is this, which is the last part: purchase of some sufficient amount of equipment in excess to the value of the amount to be bonds to be retired. So instead of giving the cash to the bondholders, I'm using that money to buy some asset which is kept with the bond. So if tomorrow the bond is closed, that asset is sold and that amount is also paid back. So there are variations. Either you give directly cash to the bondholder, either you put it to the your trustee, either you buy an asset and attach it to the bond. Everything is same. Indirectly, what is happening? The issuer is paying that amount. The issuer is paying that amount. Okay. Accelerated sinking fund. See, accelerated sinking fund means every year the percentage of bond you are retiring is increased. I'm sorry. Every year the percentage of bond that you are retiring is actually going to increase. So first year I have retired say 5,000 bonds. Next year I am going to retire 10,000 bonds, 15,000 bonds. Every year the number will go up. Okay. Every year the number will go up. There is, see, allows the firm to call back more funds in the earlier years. It is basically variations. So it can be going up, or it can be initially I have the option to retire more bonds, and then later on the numbers can go down. All of these are variation. But what is the main logic? What is a sinking fund? Sinking fund gives the ability to retire the bond every year early, and I will not wait for the bond maturity. Okay. Suppose it's a 20-year bond. Okay. And I'm saying after 7th year, I'll start retiring the bond. So initial 7 year, I will not retire. But after 7th year, every year I'm going to retire 10 percentage like that. Okay. There's an example also. If the sinking fund requirement is $1 million, it may give the trustee $1 million in cash to call back the bond. Okay. It may It may deliver to the trustee $1 million of bond it purchased from the open market, or it can, see why we are saying open market, we are saying either you hold this as a cash, or else I will give some additional bonds from the market, extra different bonds, and I will give it to the trustee. Okay, so indirectly what is happening, I am being the issuer, I am losing that cash. Okay, either I can buy an asset and give it to you, either I can give you a cash, or I can give you, purchase a bond and I can give it to you. So variations. Okay, similarly you can also buy property and plant of the required amount. Okay, likewise, so they have given you references, and certified property addition is nothing but you need to get the valuer certificate that, oh, I am adding this much new security into the asset. So think of it like this. Suppose I have a bond and already bond had $1 million worth of equipment below it. Now I'm adding $10,000 more. So I will have to add some new equipment of $10,000, and I'll have to get it certified that yes, now the overall bond that are below the overall asset below the bond is 1 million plus 10,000. That is the case. Okay, I'm going to take a pause. Let me know if there is any confusion till this point. I hope everybody is doing good. Let us move forward. Maintenance and replacement fund. From the name, what we are saying is, suppose I have a bond and below that there is an equipment. Okay, so instead of retiring the bond, okay, so retiring the bond, use that money to maintain the asset or replace the asset so that the original asset value remains. Okay, see what is happening if I am the bondholder and there is a asset below, equipment suppose below that bond, I am always worried whether that equipment value will depreciate. Correct now? It will depreciate. But if the equipment value goes down and I am not being paid, my risk is very high. So what this clause will help you is that instead of we getting the money, the investors getting the money back, that money can be used, okay, to maintain the value of the security backing the debt. How do you maintain the value? Either you do maintenance or else you add some extra equipment to it, or you replace it with the new equipment so that the bondholders are happy that okay, the equipment is of worth. If tomorrow the company is not able to pay, we'll be able to sell the equipment, right? So they do checks annually to determine how much extra asset is needed, how much maintenance is needed to make sure that the value of the asset remains up to a particular level. Okay, and if suppose there is a difference, okay, look at this. Every year they will do an audit, okay, to identify the annual amount the necessary to satisfy the fund, and any shortfall, the difference between what is required and the actual amount expensed on the maintenance is the shortfall. What does this mean? Say ideally the value of the property or value of the asset has gone down by 5,000 rupees. Okay, I have done the maintenance of spend of 2,000 rupees. There is a shortfall of 3,000. So value will ideally go down by 5, but I have taken some effort to maintain the value of that asset by doing some maintenance. Okay, and I have invested 2,000 rupees into that. But still there is a gap of 3,000. I hope everybody is able to visualize this. One second, I'll just show it to you. So there is an equipment. Let us assume every year the value of the equipment is going down by 5,000 rupees. Okay, so Now the value is here, and suppose if it is 1 lakh, now it is 95,000. Okay. Ideally, it will go down to 5. I have taken an effort and I have already invested 2,000 rupees. Okay, to maintain the equipment. I've done oiling, I've done repair and all of that. Okay, so ideally the value will not go up to that level, correct? But still there is a gap of 3,000 rupees. That is the shortfall that has been discussed over here. The shortfall is usually satisfied with unfunded property addition, which means I'll get some new asset and add it. Okay, or else whatever that 3,000 is, I can pay back to the bondholder. Either I add a new asset, okay, or else I'll give that money back to the bondholder. But the main point of this clause is to make sure that the asset is maintained up to a particular level so that the bondholders are happy. Okay, bondholders are happy. They've given you an example also. Read this section. And I'm taking a pause. Any query, any confusion till this point? I hope everybody is doing good. Let us move forward. Redemption through sale of asset. So what I can do is, suppose I have issued a bond and I want to sell, I have a property below that. Now what I can do is I want to close this bond. So what I can do, I can sell the property, get the money and pay back to the bondholder. Okay, I can pay back to the bondholder. Now generally, see, why would redemption through sale of asset is widely used? Because I do not want to have that clause in my books that okay, I cannot use that particular asset, I cannot sell that particular asset. Likewise, so look at the example. So Texas New Mexico Power Company issued $130 million in first mortgage bond on this state that carried a coupon of 11.25%. Bond was callable beginning this at this price. Okay, and there might be some asset below that call. Okay, following the sale of 6 of its utilities, that means 6 of its companies or subsidiaries. Okay, the Texas company called the bond at par on this date. They called back the bond. Okay, and before the first call date, see, ideally they are supposed to call on that date. Okay, but now what is happening, because they are selling that entity itself or selling that utility itself, they are saying we will pay back the bondholder immediately. Okay, because the asset on which the bond is issued, it is not going to stay. So we cannot have that provision because the asset which is making it as a secured bond, that asset itself is going down. Okay, because what was happening, because of some regulation or something, they were forced to sell that 6 properties or 6 utilities, and that bond was based on that utility. Now, if the government is saying sell this asset, you'll have to sell and give it back to the bondholder, whatever it is, but the bond will not continue. Correct? Because the government or legal requirement is there to sell. Okay, it was forced to sell the 6 utilities by municipalities. Okay, and if those 6 utilities has to be sold, you'll have to close the bond and then sell, right? So they will have to call back the bond immediately, pay back to the bondholder and sell the asset. This is the redemption through sale of asset. Okay, in the book I think so they have taken only 2 lines of that. Sab log hai na saath mein, everybody is okay? Then there is tender offer. Now what is tender offer? Tender offer means I am making an open offer to everybody in the market. I want to buy back my bond. Okay, I want to repurchase the bond. Whoever are the existing bond holders, I'll pay them this much amount. Before this date, you can come to me and you can give the bond and I'll pay you the amount. Simple. So you will give advertisements in newspaper and all of that. Okay. So intent is to buy back the bond. Either you will say, I want to buy back, say, bond worth 5,000 crore. or else I can say I want to buy back the entire bonds, all the outstanding bond or a fixed amount of bond. Okay. The price of the buyback can be a fixed price. That means I am explicitly highlighting in the advertisement that for one bond, current price is 107, I'll pay 110. Okay, or else it can be fixed price or it can be calculated. Now, calculated logic has to be written down, explained. So, what generally they do, they will calculate what is the future present value of the future cash flow of the bond, and they will take the present value of that, and that will be used to pay today's price. Okay, pay today's price. Okay, one more section, which is this. Why would you do a tender offer? Why do you want to buy back your bonds? Okay, one reason is I want to reduce my debt. Because suppose the company has huge amount of debt, okay, there might be pressure from the shareholder that reduce the debt. Okay, there could be pressure from the business that the expense of interest is very high. We should change. We should pay back. Okay, because the debt is increasing and the rate of interest that we are paying is also high. So let us buy back the bond. Okay, manage capital structure. Suppose in my capital structure, 70% is debt and 30% is equity. Okay, now suppose I want to do IPO, for example, and IPO rules are saying that you should have maximum debt of 50%. So I'll have to reduce that 20%. So how will I do? I'll buy back the bond. Okay, take advantage of the lower interest environment. I have already issued a bond at 10%. Now the market interest rate is very low. I can buy back the bond and I can issue a lower bond at a lower rate. But this is not a call feature. I'm going to the public to buy back. Okay, I'm going to the public to buy back. Avoid triggering covenant that may apply to more aggressive mechanism like call. Now, avoid triggering covenant means, see, very simple. Suppose I have issued a bond, okay, and I have a property on which I have issued a bond. It's a secured bond. Now I want to develop that property. I want to create a building. I cannot do that till the time the bond is active. So I can issue a tender offer, get the all bond back, then I can do whatever I want to do with the property. Correct? Because in the bond, there was a covenant that you cannot use this property. So I want to avoid that bond. I want to avoid that covenant. So I'm basically going to buy back or basically issue a tender offer. Okay. This is voluntary. So you cannot force the bondholder to accept the offer. Okay. Because I'm going to the public. So how do I make sure that everybody is giving me the bond back? I'll have to make sure that the price is slightly higher. I'll have to make it attractive. Okay, like slightly attractive. So you'll have to make it market friendly. It should be seen as less aggressive. Okay, or else nobody will give you bond back. If it is not useful for them, why would they give? Simple. Okay, can help in liability management and credit rating stabilization. Now, if the debt is reduced, okay, my liability is reduced and my rating should improve. So if the requirement of the company is to make sure that the rating goes up and the debt is managed, they will go for this. They will retire the bond early. They will not wait for the maturity. I'm taking a pause. Any query, any confusion till this point? All good? Look at this in the context of corporate utility bonds. What is the correct interpretation of the role of maintenance and replacement fund clause? Read all the options. See, it is designed to maintain the collateral value, but it cannot be used for debt repayment. Wrong. In one of the section, it was cash being paid. Read all the option, please. Read all the options. Yes. So a lot of people are answering that is correct. It is C. See, we have to maintain the value of the bond, because if the bond is worth 100, the asset should also be worth 100. But you should also be mindful that it can be used for early retirement. That was the main section, retirement of the bond. So answer is C. All the details are given here, right? Okay guys, thank you very much for joining in. We're going to be starting out with the next module of the chapter, where there are 3-4 things that we're going to be covering. One is your credit risk, because whenever you're buying a bond, you're facing this credit risk because the bond issuer might default, right? Then what is an event specific risk, merger and acquisition, if that happens, how it is going to impact. Next is high yield bond. High yield means high rate of interest. These are risky bonds. Okay, so all of these 3 things are covered in this next module. Okay, now when we talk about credit risk, okay, see the word default. Now think very simple. Suppose if I have purchased a bond and Sahil, for example, is the bond issuer. If tomorrow Sahil does not have the ability to pay me back, okay, or he misses on payment of interest, payment of principal amount, what will happen? Effectively, I'll end up facing a huge credit risk. Okay, so if the issuer missed on the interest, missed on the principal payment, which was specified in the bond indenture, then there is a problem. But how do we analyze this? We basically look at what is the rating of the bond. So there is S&P, Moody's, Fitch. These are the top agencies, rating agencies in the world. So they have been giving rating to these bonds. So ideally, I should be only buying bonds of high rated companies, right? So AAA is the highest credit rating that anybody can get. Okay, but what will impact this credit risk? The probability of default and the likelihood of default. So there was this chapter where we, the first chapter, building block of risk management, where we basically talked about expected loss. Expected loss is nothing but exposure at default, loss given default, and the probability of default. So PD means chances of default. LGD means loss given default. This is the severity, how much I'm going to lose, right? And this is the overall exposure, how much amount I'm expecting from my bond issuer, right? So ratings gives you an idea of what is the chances of that company defaulting. If that default happens, how much is the rating change also happen. So for example, default has not happened, but the transition has happened. What is transition? Previously somebody was AA, now it has become single A. The rating has gone down or the rating has gone up. So what are the chances of a complete default and what are the chances of a rating movement, rating transition? Because suppose if the rating goes down, that means the risk is increasing. That means the credit risk is increasing. Okay, that is the overall idea. Now, we are also talking about credit spread risk. Now, what is credit spread risk? Suppose if I have an Infosys 10-year bond, which is having a yield of 7%, I'll be comparing it with the risk-free bond. What is the risk-free bond? Government of India bond. Same maturity, 10-year. Suppose the Government of India bond is 5%, whatever is the gap, that gap is the spread, that is the credit spread. If you remember at the start of the topic, we explicitly talked about this, credit spread. If the spread is widened or bigger, that means higher risk. If the spread is smaller, lower risk. So I always compare it with a risk-free benchmark. Okay. Now, if the risk is higher, what will happen? The spread will widen. Okay. And when will this happen? When the bond of Infosys is going down, the price is going down, right? So whenever the spread widens, the bond value will go down. Correct? So what is a credit spread risk? It is nothing but difference between the yield of bond and yield of treasury, government bond. Yield of bond and treasury. Right? What are the factors? You can mark this as star. What are the factors which are going to impact? What are the factors which are going to impact the overall bond, the spread? Okay. Changes in the credit worthiness. That means Infosys was previously very high rated. Now the rating has gone down. When the rating goes down, what will happen? The bond price will go down and the spread will widen. What is the liquidity condition? Now suppose there is some bad news about Infosys and nobody wants to buy Infosys bond. So what is happening? The liquidity has gone down. When the liquidity goes down, the risk goes up. So automatically the spread will widen. Okay. Last, is there an option in the bond? Callability is one option. You can have callable bond, you can have puttable bonds. We have already talked about callability, right? If the bond is callable, the price will be lower. Why? Because there is higher risk for the investor, right? So that all of these factors will impact the price of the bond. And when the price gets impacted, the yield gets impacted. When the yield gets impacted, the spread gets impacted, right? One more connecting point. It widens during economic downturn. What does that mean? See, whenever the economy is going down, what will ideally happen? Okay, what will ideally happen? The Infosys will not perform good because it's a very big organization. It is connected to what is happening in India. So when the economic downturn is there, recession is coming, Infosys will also go down. So the price of the bond will go down and the spread will increase, which highlights higher credit risk. Higher credit risk. I'm taking a pause. Any query, any confusion till this point? I hope everybody is down. Good. If economy is down, government bond is also government bond will be more favorable because there'll be flight to quality. People will try purchasing government bond, right? The price will go up. Let us move forward. Now see, there is a concept of spread duration. Now this concept of duration will come when you look at bond valuation. Okay, I'll give you simple understanding as of now. What is duration tells me? Duration of a bond basically tells me if the interest rate is going to change. Okay, how much the bond price is going to change. Because we know now if the interest rate increase, the bond price will go down. Right? If the interest rate goes down, the bond price will go up. But how much it will go up and down, that is basically explained by duration. But the concept in the book right now is spread duration. What is spread duration? If the credit spread, what is that credit spread? This gap of 2%. If this credit spread is going to increase or decrease, how much the bond of Infosys price will change? That is spread duration. Right? So what is the sensitivity of the bond price to change in the credit spread, assuming that the government bond yield is same? It is not changing. Government bond yield is 5%. Only the Infosys yield is changing up and down. So the spread is increasing or decreasing. Then how much the bond price will get impacted? That is what the spread duration tells me. Okay. What is the formula? Okay. Spread duration into the change in the yield. Change in the spread. So for example, if the bond spread duration is 4, okay, and we are saying that the spread, which was 2%, is changing by 50 basis points. From 2%, it is becoming 1.5%. So what is the change? 50 basis point or 0.5%. So I'll multiply these two things and it will give me an idea that how much the bond price should go down. Okay, if the interest rate is going down, the spread is going down, reducing, then the bond price should go up. But if the spread is increasing, the bond price should go down. Okay, so whenever there is a 50 basis point change in the spread, okay, how much my bond price is going to get impacted? That is going to change by 2%. Okay, now in this case, the spread was increasing. Whenever the spread is increasing, that means high risk, that means the bond price should go down. How much? By 2%. I'm taking a pause. Any query, any confusion till this point? So what is happening? See, this is my spread. I'm going to repeat the entire concept. Okay, 5% is the government bond. Okay, Infosys bond is 7%. What is the spread? 2%. I'm saying if this spread suppose goes up, the spread becomes 2.5%. Why? Because this is becoming 7.5%. Spread is increasing, risk is increasing. So bond price should go down. How much it will go down? So spread duration, okay, suppose the spread duration is 4. And what is the change in the spread? From 2% it is becoming 2.5%. So what is the spread duration? 4 and then multiplied with the change in the spread. This is my spread duration and this is my change in spread. When I multiply, I get an answer of 2%, right? This 2% is the decline in the bond price. Because what is happening? The spread is increasing. When the spread increases, it is risky, na? So the bond price will go down. If the spread decreases, the bond price will go up. Is everybody good till this point? Can I get a quick confirmation on chat? Got it? Event risk. Now suppose you have purchased a bond, okay, of any particular company and specific event happened with that company. It can be merger and acquisition, some restructuring. Obviously, you as a bondholder who is expecting money from that company, you will get impacted, right? So that is what has been explained. So what is event risk? Okay, event risk is nothing but potential negative impact to the company's credit quality and the bondholder's value because something major is happening. And these major are called as corporate actions. Okay, now what are these corporate actions? The list is actually given over here. Merger and acquisition. Okay, recapitalization, it could be you have issued new shares, you have issued new bonds. Okay, leverage buyout, that means somebody has, suppose ITC as a company. Okay, I want to do a leverage buyout of ITC. I'll borrow money from market, from hedge funds, and I'll buy the entire company of ITC. 10,000, 20,000 crore rupees. Possible. So if leverage buyouts are happening, the ownership is changing, right? If there is corporate restructuring, some businesses are closed and sold to others. Say for example, what was that? India Cement. Okay, that is the entire group. They have one business, India Cement. They are selling that India Cement business to Aditya Birla Tech. Possible. The entire, that is restructuring. You're selling a particular business, you're closing down a particular business, okay? Or a large scale buyback. That means companies buying back the shares of the company. These are all corporate action. Whenever these corporate actions happen, big events, it might impact the rating because there is a chance that the risk is increasing. When the risk is increasing, the rating will go down. Or it will impact the value of the bond. Okay, because whenever these structuring, these events happen, okay, there could be a chance that the credit worthiness will go down. That means the company will become more risky and there is less chances that they will pay back. The value of the bond can go down. Also, the debt level can increase. If recapitalization is happening, then there is a good chance that the debt will increase. And I am the bondholder now, I'm worried that whether I'll be paid or not. Right? So, any event, big event, which impacts the organizations, okay, in terms of the debt, in terms of the chances of default, automatically is going to impact the bondholder and the value of the bond will go down. Okay. Look at the next part. So how do we make sure that the bondholders are protected against this? So generally they add a net worth clause. Okay, what is the net worth clause? It has been added to protect the investor. How? They are basically going to say that if any major event happens, okay, you have to make sure that the company's equity, that means the shares, okay, is maintained at a minimum level. If the share price go below a particular level, then you will have to give us the money immediately. You can put a clause into that. Okay, the purchase outstanding debt at par to restore the balance in the capital structure. It simply means that we are making sure that the shareholders' money is there in the business for certain, till that certain level, because tomorrow if the company is liquidated, that money can be used to pay back the debt amount. If that money is going down, the risk of the bondholder is high. So what they can say, oh, if the money is going back, we'll have to immediately pay us back. If that equity level is going down, because the equity is shareholders' money. If the shareholders' money is going down, you'll have to pay us back. Okay. Look at the next part. Why do we add all of these clauses? Because we do not want the company to keep on taking more and more debt. We do not want them to have excessive leverage. Leverage means taking somebody's debt, right? So it can be the situation that I have issued a bond. Okay, bond A is issued and I'm taking more and more bonds. When you take more and more bond, the leverage will increase and the risk will increase. Okay, these clauses help the bondholder because that will help to maintain the rating of the company. Okay, and when the rating is maintained, the chances of default is maintained. Okay, and the bondholder has the surety that I'll get the money back. Okay, similarly, can limit management discretion you during financial engineering events. So, see, when we are saying financial engineering, what they say is that they will meet the requirement of the clause. Okay, but they will create something which will make it nullified. See, very simple example of this is I will issue more and more equity shares so that the total value of the share equity is not going down because I'm issuing more and more shares. Okay, but this might be against the requirement of the bondholder. So basically what we are doing, we are adding all of these clauses to protect the bondholders so that the management of the company don't take them for a ride. That is the idea. Take a pause, read this entire section. I hope everybody is doing good. Now, high yield bonds. High yield means that the interest that you are paying is very high. Why would somebody pay high interest to you? Because the risk is also very high. Correct? So, high yield bonds, okay, high yield bonds are debt securities generally below the investment grade. See, the top ratings are investment graded bonds. You're below that. So, when you're below that, okay, below triple B, okay, then what happens? Your risk is very high. Now, if I'm an investor, I'm going to buy this bond, I will always think that why am I taking high risk? Because you're compensated with higher yield for that higher risk. Okay, higher yield, higher rate of interest is paid to you. Okay, now read this next line. Over long period, high yield bonds tend to offer higher average return. Okay, but for a shorter period of time, they are volatile. Why? See, these bonds are risky bonds. If they're able to survive for an initial few 5-10 years, then they will be stable because the difficult period they've been able to survive, or else they'll be closed, the company will be closed. Okay, so in a short term, the volatility of the price is very high, but if they're able to survive that, then there is stability in the price. Okay, that is what they are highlighting. And especially if there is economic downturn, that means recession. During recession, these high yield bonds will face problem because they are risky companies. Their businesses are not very stable. And if the economic downturn happens, there are high chances that they might go down. Right? So returns are highly volatile and subject to significant losses, especially during economic downturn. Downturn means recession. Okay, now, but if you're going to look at the window of say 30 years, 40 years, they provide, if the company is able to survive, they will end up providing high returns for the investor. They will provide average high returns. Okay, but they should be able to survive. That is the risk that you are taking. If they are not able to survive, then you are gone. Correct? There's one more connecting slide to this. Okay. Okay, these issuer, generally they issue bonds, high yield bond, if their rating is down. That is the general logic. Say if my company is not very good, if the rating is down, I want to raise money, so I'll have to issue a high yield bond, which is nothing but the interest rate is very high. If you are a startup or very young company, you do not have any history to show. In that case also, the investor is going to face a high risk, so he will ask for a high rate of return. Okay. And sometimes used by the firm with steady cash flow to fund large dividend. Now what is this? I am going to raise money from the market through bond, and whatever money I'm getting, I'm going to utilize that to issue dividend. Okay. Fallen angels. Now fallen angels are nothing but some companies who are initially very good, their ratings were very good, but because of some incident, some event, the rating has gone down. There has been a downgrade. And now when they're issuing the bond, they are more risky. So they have to issue a high yield bond, because initially they were very good companies, the rating was very good. Now the company has gone down because of some credit problem, some issue. Okay. I'm taking a pause, read this entire section. All good. Let us go forward. Coupon structure in a high yield bond. So variety of structure. One is deferred coupon structure. Now generally, if you are going to invest the money into a project, and suppose the project is not going to give you money in the first 3-4 years, so what I will do, I will issue a deferred coupon bond, which means initial few years there's going to be no coupon, but I'll be start giving you coupon after 4th year, 5th year. Example. So no interest is paid at the initial year, but it starts later. So do you realize a zero coupon bond is also a deferred coupon bond, but in zero coupon bond you are paid at the last. In this bond you'll be paid after a few years. There is one more variation, step up bond. What is happening in step up bond? Initially the coupon is low and gradually the coupon will go up. So everything is written in the document from the starter. So coupon rate will increase steadily. Why? Because this is one of the technique to make sure that the investor put their money, because these are high yield bonds. No? So to appeal the investor, they'll basically issue a step up bond. They'll basically say initially you will get low interest, but as you progress, the interest component will increase. Okay. One more section, payment in kind bond. So what is this payment in kind bond? Instead of giving you cash, I'm going to give you one more bond of my subsidiary. So I'm paying you, but I'm not paying in cash, I'm paying in kind. Allow issuer to pay interest in the form of additional bond instead of cash. Again, the issuer would be aware about it. He would know if the risk is higher, he will expect a higher return. Right? Why would they do that? Because the company does not want to give cash right now, because they need cash for growth. So they are going to preserve the cash, and instead of that, they will give you one more bond. Right? Come to the last section, extendable reset bond. Allow issuer to adjust the coupon rate periodically. Okay. So suppose if the interest rate has gone down, after 5 years, the bond coupon will be reset. Reset means if the interest rate has gone down, the coupon will also become lower. If the interest rate has gone up, the coupon rate will also go up. Very simple. See, I have issued a bond to Madhav, say for example, a 10% bond. Okay. It's a extendable reset bond. And it's a 20-year bond. And after 5 years, the coupon rate in the market is 17%, but I'm still paying 10%. If there is an extendable reset option, the interest rate will move to 17% for the bond. Right? Generally, this helps when the interest rate goes down. It protects the issuer, because now I have to pay a lower rate of interest. Okay. I'm going to take a quick pause, read this entire section. I hope everybody is reading in the textbook. Recovery rate and default rate. recovery rate and default rate. Okay, now why this concept is coming? Because see, when I'm going to if the issuer is defaulted, so you will basically sell the properties of the issuer, because you are a bondholder, you would want that to be available, you want your money back, right? So that is where the recovery rate as a concept comes into picture. And also default rate, that on an average how many people are actually defaulting in the market, right? I'll address the query. Wait, Nitin. Okay, so default means the company is not able to pay back the interest and the principal. Okay, when will this happen? When the ratings have gone down. When the rating goes down, what happens? The risk is very high. So lower credit ratings are associated with higher risk. Okay, so there are two formulas that we're going to be looking at: issuer default rate and dollar default rate. Now, issuer default rate means it's a count. Suppose at the start of the year, there were 100 companies who had issued the bond. At the end of the 1 year, it is only 90. So you are going to say how many people defaulted? 10. What was the total number at the start? 100. So the default rate is 10%. It's a count based approach. It does not look at how much is the amount that is being raised. We are only looking at the number of issuers. That is the first one, issuer default rate. Okay. Similarly, there is one more which is called as dollar default rate. See, issuer is here. What is dollar default rate? I am actually looking at total value of the bond issued by those 100 people. See, at the start of the year, if total $100 million worth of bond was available in the market, issued in the market, and at the end of the 1 year, it is only $90 million that is left. That means $10 million worth of bond is defaulted. So I am now looking at the dollar value. Okay, there are two formulas that you see in the book also. The first formula takes into account the overall total default in dollar terms divided by the overall value of issuance into the weighted average. Now, why weighted average? See, every bond does not have the same maturity. Somebody is open for now next 5 years, somebody is open for 20 years, somebody is open for only 2 years. So we have to take that into consideration when you're hitting the weighted average number of years outstanding. For how many years that bond is actually now going to stay. So in this first formula, you're hitting weighted average. In the second formula, you're not hitting. You're considering everybody as same. That is a primary difference. Okay, generally in the exam, you'll not see a question, calculation-based question coming from here. It is mostly going to be theory if they ask you. I'm going to take a pause, read this entire section. Nitin, answering to your query, PIK is similar to stock dividend? No. Stock dividends are issued for the shareholders. PIK is slightly different. It's a bond concept. All good? Let us move. This is the same thing. Total value of the bond defaulted, divide par value of the bond defaulted and total value. It's the same dollar default concept. Okay. And we also take weighted average, which we have seen in the previous formula. Okay. Now recovery rate, you can mark this as star. What is the recovery rate highlighting? Okay. Suppose, see what the research has highlighted, that if you have purchased a senior bond, then ideally you get 38% of the recovery. This is the average recovery. But if you have purchased a senior bond, you will get more recovery. If you have purchased a junior or a subordinate bond, the recovery will be lower. Right? So what generally investors look at, okay, when they look at the recovery rate, they will look at amount recovered after default. Okay, suppose the total amount due was 100. When you sold the properties of that company, you only got $40 back. Okay, so the recovery rate is 40%, right? This is basically from the thought process that, okay, how do I calculate 100? We look at what is the present value of the remaining cash flow. Because see, the bond was outstanding for 7 years now, suppose. More 7 years are left. And more 7 years, the coupon will come, the principal will come. So I'll calculate the present value, okay, of the remaining cash flow. And that present value is the total amount due. Okay, and I only focus on the if I look at non-cash part, because in certain bonds it is payment in kind also, right? So the calculation will be slightly different. Primarily we look at the cash component, that if the bond is going to default, how much I would lose in cash, and that becomes a total amount owed. I will sell the properties of the company and I will see what is the amount of cashback I'm getting. That is basically the recovery rate. Okay, I'm taking a quick pause here. Read this entire section. I hope everybody is good. Now this, see, recovery rate is directly connected to your frequency of default and severity of default. What does that mean? Okay, see, frequency means percentage of chances of default. Okay, severity means if the person default, how much I would lose. Okay, so severity of impact, okay, which is nothing but how much dollar value I'm going to lose. Frequency is how many percent chance that the person will default, will not be able to survive. Right? So both of them impacts recovery rate. Right? If the more and more people start defaulting, the recovery rate will go down. Right? And automatically my severity will be higher. Okay. Next and the final concept in this chapter is the expected return. Everybody with me? Okay. So what is the expected return? See, generally what we look at is, suppose if I'm buying an Infosys bond, okay, Infosys is giving me 7% yield, government bond is 5%, what is the gap? 2%. So how do I look at it? I basically look at it from the perspective that this is my risk-free rate, this is the premium. Okay, what is the premium? Because I'm holding an Infosys bond, there is risk, so I should be compensated, na? So that 2% is a compensation. So risk-free rate plus the premium, which is nothing but 7%, minus the expected loss. Because I am holding an Infosys bond, okay, there is a good chance that I might lose because the Infosys might default, right? So let us assume 0.5% is the expected loss. Then I am actually earning only 6.5% on the bond. That is the expected earning. So if you go back to the formula, risk-free rate is nothing but that 5%, credit spread or the premium is the 2%, minus the expected loss rate. How do we calculate the loss rate? Probability of default into loss given default. Probability means chances of default, and if the person defaults, how much percentage I would lose. And this loss given default is connected to 1 minus recovery rate. Because if my recovery rate is 30%, then the loss given default is 70%. If the recovery rate is 40%, my loss given default is 60%. So what is the formula for expected return? You can mark this as star. Risk-free rate plus the credit spread minus the expected loss. How do you calculate expected loss? This is the formula. Okay. Taking a quick pause, read this entire section. Let us move forward. Now, if Infosys is a very good rated company, the spread will be lower, right? Smaller difference between the credit spread and the expected loss. Okay, because the company is very highly rated. Okay, but if the company is low rated, what will happen? Okay, the expected loss, the spread will be higher. Why? Because if you are an investor and you are saying that I am going to invest into a startup, the risk is very high. So above risk-free rate, okay, the spread will be higher. Okay, and you have to be compensated for the risk that you are taking, right? So larger difference will be there between the credit spread and the expected loss. So I'll give you an example. So suppose there are two companies. Okay, company A is Infosys, which everybody is aware. Company B is a startup. Okay. This is a government bond. Okay, 5% is the yield. Infosys bond, yield is 7%. Okay, what is the spread? The spread is 2%. And what is the expected loss? I'm going to write it over here. Expected loss is 0.5%. So when you calculate, your expected return is 6.5%, right? What is the difference between the credit spread? Difference between the credit spread and the expected loss? The difference is 1.5%. Okay. Now suppose we are looking at startup. So government bond, 5%. Okay. The startup will be like, say, for example, 15% because it's high risky. So what is the spread? 10%. Okay. Expected loss is 4%. So what is the difference between the credit spread and the expected loss? Guys, what is the difference? What is the difference between the credit spread and expected loss? 6%. See this difference between these two. Why this gap is bigger? Because if I am an investor, I should be compensated. Now I am taking such a high risk. The gap should be high. Or else why would I invest into a startup? I would invest into an Infosys company. No? Correct? Mark this as star. They have given you the example also. Risk-free rate is 3%. The credit spread is 1.5%. Probability of default is 2% and the recovery rate is this. So what you can do, you can take 2% into 1 minus 25%. This will give you the loss given default. Sorry, this will give you the expected loss. Whatever is the answer, minus it, okay, from the combination. 3% plus 1.2, that is nothing but 4.2, minus the expected loss, the final answer is 2.7%. I'm taking a pause. Let me know if there is any confusion here. All good? Let us look at the question, the first question. An investor is analyzing a fixed income instrument with a maturity of period of 3 years. How should this bond be categorized? Is it going to be a short term or a medium term bond? This is easy because we mentioned, na? 1 to 3 year is a short term bond. Yes. Answer is B. Read this question fast. If a company has issued a zero coupon bond, files for bankruptcy, what will be the claim in the liquidation process? If you remember, we said the offer price plus the accrued interest. That is what ideally you are going to get. So issue price along with the accrued interest. We explicitly talked about this. Assuming all the factors are constant, which of the following bond type would generally have carry the lowest risk? Lowest risk. This is easy. See, you have to think whether it's a secured bond or unsecured bond. See, debenture has unsecured, so high risk, right? It is secured. But when you compare equipment and this, equipment trust certificate has a lower risk because who has the control of the asset? The trustee. In a mortgage bond, the issuer has the control. So answer is going to be A, na? Everybody, A. It is most secure. Correct, na? Look at the next question, everybody. Which of the following provision for early retirement of bond typically exposes the bondholder to greatest disadvantage? Yes. Read all the option. Prashant. Answer is call provision. Because in the call provision, the price is generally fixed. So you do not have control to change it and the risk is higher because you will be paid only a certain amount. So it's a call provision. Okay. Look at the next part. An analyst is evaluating a corporate bond X which is trading at a credit spread of 120 basis point above the treasury security. The bonds carry 2% probability of default. Expected recovery rate of this. Interest rate is 3%. I think so. We calculated this answer, no? This number. We got 2.7 na, in the previous section. This is the same answer. Yes. 2 point. Same formula, same calculation. Check this example fast. A bond's maturity marks the date when the issuer is obligated to fulfill the contract term. Consider the following. Which of the following statement is correct? On the maturity date is when the issuer must fully honor its repayment obligation under the indenture. Is this correct statement? Right, na? On the maturity date, he is ideally expected to pay. Okay. So, if one is right, this goes out. Okay. On the maturity, the bondholder receives the principal plus any accrued interest and applicable premium. Okay. The issuer and the bondholder has no flexibility to modify the bond maturity under. No, this is wrong. This is straightforward wrong. So most likely 1 and 2 is correct. Okay, because you get any premium, any left extra part that is there. So most likely the answer is going to be B. Yes, this is also true. This is entirely wrong because certain bonds can be retired early. We have already talked about this sinking fund provision. Okay, look at this question. Which of the following best reflect the historical trend and the institutional reality revolving sovereign default? I think so. This is a wrong previous chapter question. We have made a mistake. This is from country risk. So ignore this. This is from country risk. Okay. So we have completed this chapter. Any queries, any questions, guys?